Did you know that nearly 90% of individual investors underperform the market? That's a shocking number. It means that most people who try to invest end up losing money instead of making it. In fact, a study by Dalbar shows that the average investor earns about 2% less per year than the S&P 500. This gap can cost you hundreds of thousands of dollars over time. Why does this happen? Many investors let emotions guide their decisions. They chase trends, panic during market drops, and often overlook hidden costs. All these mistakes can drain your profits and lead to failure. But it doesn't have to be this way. In this video, we'll explore the key reasons why most investors struggle and how you can avoid these traps. We'll uncover powerful strategies that can help you build real wealth. From mastering your emotions to understanding hidden fees, each chapter will give you the tools you need to succeed. So, if you want to beat the odds and become a successful investor, stick around. Let's dive into the world of investing and learn how to turn your money into lasting wealth. Chapter 1. The Psychology Trap. How emotions sabotage investments. Investing isn't just about picking the right stocks or assets. It's about managing emotions, and that's where most people fail. Emotions, like fear and greed, can destroy even the best strategies. When markets drop, fear sets in. Investors panic and sell, locking in losses. When markets rise, greed takes over. Investors chase high prices, often just before a crash. This cycle repeats itself over and over. Daniel Kahneman, a Nobel Prize-winning psychologist, once said, "Investors would rather avoid loss than gain the equivalent amount." This is called loss aversion, and it explains why we hate losing money more than we enjoy making it. According to a study by Dalbar, the average investor underperforms the market by nearly 4% annually, mostly due to poor timing and emotional reactions. How do you avoid this trap? One key strategy is setting strict rules before you invest. Decide when to sell or buy, and stick to those rules no matter how you feel. Automation can help too. Setting up automatic investments, like dollar-cost averaging, removes emotional decision-making from the equation. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Following this advice can help you stay calm and make better decisions in the heat of the moment. Chapter 2. Chasing FOMO. Why following the herd always backfires. Fear of missing out, or FOMO, is a huge reason why many investors fail. We see others getting rich and feel like we're missing out. So, we jump in, often at the worst possible time. This herd mentality can be disastrous. According to a study by Morningstar, investors who chased recent top-performing funds earned about 2% less annually than those who didn't. Take the dot-com bubble in the late 1990s. Everyone wanted in on tech stocks. By 2000, the bubble burst, and many lost their savings. The same thing happened in 2020 with GameStop. People bought because they saw everyone else doing it. But by the time they jumped in, it was too late. Prices plummeted, and many were left holding losses. Instead of following the herd, successful investors think independently. One way to avoid FOMO is to focus on fundamentals, not trends. Ask yourself, is this a good investment based on its value, not just its hype? Another strategy is to wait for opportunities. You don't need to jump into every hot stock. Sometimes, doing nothing is the best move. As Charlie Munger said, the big money is not in the buying and selling, but in the waiting. Patience allows you to avoid the herd's mistakes and wait for better opportunities. Chapter 3. The Illusion of Quick Wins. Short-term thinking versus long-term wealth. Many investors fail because they expect quick wins. They treat the stock market like a casino, hoping for a big payout in a short time. But investing isn't about getting rich overnight. It's about building wealth slowly over time. Studies show that over 90% of short-term traders lose money. Even worse, those who try to time the market often end up missing the best days. According to research by JP Morgan, if you missed the 10 best days in the market over a 20-year period, your returns would be cut in half. Staying invested long-term is the key to success. Take the S&P 500, for example. Over any 20-year period, it has never had negative returns. This proves that time in the market is far more important than timing the market. The power of compounding is another reason to think long-term. Albert Einstein once called compounding the eighth wonder of the world. The longer you stay invested, the more your money can grow exponentially. For example, if you invest $10,000 at an 8% annual return, in 10 years, it becomes about $21,589. But in 30 years, it grows to over $100,000. To succeed, shift your mindset from short-term gains to long-term wealth. A solid strategy is to focus on diversified, low-cost index funds or ETFs, which historically outperform most active traders. Keep your costs low, reinvest dividends, and allow compounding to do the heavy lifting. Remember, successful investing is a marathon, not a sprint. If you're enjoying this content, don't forget to subscribe for more insights and strategies that can help you succeed in investing. Chapter 4. Information Overload. Why too much knowledge can hurt your portfolio. In today's digital world, we are bombarded with information. From financial news to endless market data, it's easy to feel overwhelmed. But more information doesn't always lead to better decisions. In fact, too much data can lead to analysis paralysis, where you overthink every move and end up doing nothing, or worse, making rash decisions. A study by Fidelity found that the accounts with the best performance were those of people who forgot they even had an account. This highlights how less trading and less reaction to every market movement often leads to better results. Constantly checking your portfolio and reacting to news can trigger emotional responses that hurt your returns. Instead of consuming every bit of financial news, focus on what truly matters. Successful investors prioritize quality over quantity. For example, when Warren Buffett invests, he looks at a company's long-term business model and intrinsic value, not daily price fluctuations. One effective strategy is to tune out the noise and create a checklist of key metrics to follow, such as a company's earnings growth or debt levels. This simplifies decision-making and prevents you from being overwhelmed by irrelevant data. Chapter 5. Hidden Costs. The fees and taxes that drain your profits. Most investors don't realize how much hidden fees and taxes eat into their returns. According to a 2019 Morningstar report, the average mutual fund fee is around 0.45%, but actively managed funds often charge over 1%. This might not sound like much, but over time, it can add up to significant losses. For example, paying 1% in fees on a $100,000 portfolio could cost you $30,000 or more in returns over 20 years. Taxes are another silent killer. If you trade too frequently, you can end up paying short-term capital gains taxes, which are taxed at a higher rate than long-term gains. In the US, short-term gains can be taxed up to 37%, depending on your income bracket. Compare that to long-term capital gains, which are taxed at a maximum of 20%. This difference can dramatically affect your net profit. To avoid falling into this trap, consider investing in low-cost index funds or ETFs. These funds often have lower fees and, since they aren't traded frequently, help you avoid short-term capital gains taxes. Another strategy is tax loss harvesting, where you sell investments that have lost value to offset gains, lowering your overall tax bill. Being mindful of these hidden costs can significantly boost your long-term returns. Chapter 6. The Power of Patience. How successful investors master the waiting game. Patience is often the most underrated quality in investing. Many people want quick results, but investing rewards those who are willing to wait. This doesn't just mean holding onto investments for a long time, but also being patient with market volatility. The stock market goes up and down, but over the long term, it tends to rise. Consider this. Between 1950 and 2020, the S&P 500 had an average annual return of about 10%. However, the market experiences corrections, drops of 10% or more, roughly every 2 years. Investors who panicked and sold during these corrections missed out on long-term gains. A study by Dalbar found that the average investor earned only 2.9% per year over a 20-year period, compared to 7.2% for the S&P 500. The reason? Investors got nervous and sold during downturns, instead of waiting for the market to recover. The key strategy here is to stay the course. Successful investors like Warren Buffett and Charlie Munger are famous for holding their investments for decades. Their strategy is simple: buy good companies, hold them, and let time do the rest. Even if the market dips, they stay patient because they believe in the long-term value of their investments. Another way to practice patience is by setting long-term goals and sticking to them. If you know you're investing for a goal 20 years down the road, it becomes easier to ignore short-term noise. This mindset shift can help you avoid making emotional decisions and keep your eyes on the prize. If you found these insights helpful, make sure to subscribe for more valuable strategies and tips on how to become a successful investor.